Oaktree Capital's Howard Marks added fuel to the argument that active management can be superior to the passive approach. He wrote in a memo this week, the vast growth of ETFs and their popularity has coincided with the market rally that began roughly 9 years ago. Thus, we haven't had a meaningful chance to see how they function on the downside. It's not hard to imagine the popularity that fueled the growth of ETFs in good times working to their disadvantage in bad times. We are joined now by Chris Davis, Chairman and Portfolio Manager at Davis Advisors. And Chris, you are a human being. You specialize in active management. What's your take on Howard Marks's views that were expressed in that quote?
Well, anybody that's studied Howard Marks over the decades knows that it's usually a mistake, a loser's game, to be on the other side of Howard. He's got an incredibly comprehensive view, and here he's obviously right. And I'll give you an existence proof. We have only 5 strategies at our firm. One's almost 50 years old. One is over 25 years old. One's over 20. One's approaching 15, and one's around 10. All 5 of them have outperformed the indexes after fees since we started them and outperformed their peers.
All right. One thing that's interesting is that Howard Marks was using ETFs almost synonymously with passive management. So how can ETFs be translated into something that represents active, but with a more tax-efficient banner or wrapper?
Well, I think we were really the first, and so far really the only true proven active manager to offer our services in a true ETF form, completely transparent. And I think we had some advantages that made it possible for us to do so. We're already low cost, so we didn't have to worry about fee arbitrage. We're by and large cap investors. We have generally low turnover and a culture of transparency.
I just want to show you what you're looking at, because this is really quite an amazing chart. This is the flows in, or in this case, out of actively managed equity ETFs. People do not like them. Those are flows out, negative, negative, negative. Why?
Well, this is terrific. This is a tsunami. And of course, as a long-term investor, you know that looking at the herd when they're galloping one way and considering the other direction is usually sort of the root cause of success. This has turned into a tsunami, and you get in a lot of trouble with a good premise by carrying it too far. After all, you had never lost money in single-family residential real estate. Your home was your best investment, guaranteed to make you rich. That was true, it was true, it was true, until everybody galloped in. And I think that's what's happening with passive versus active. We have an advantage that we're owner-operators, we're managing our own money. Yeah. We can do it for a big crowd or a small crowd, but we're going to stick to the fundamental view that judgment and experience are advantages when you're a fiduciary for somebody else's savings.
You just made an analogy, somewhat tacit analogy, between subprime mortgages and passive ETFs. I'll let that stand there. But one thing I want to ask you about is that we have not seen the same kind of tsunami out of active bond funds. And even active bond ETFs have seen inflows in recent months. Why have active managers in the fixed income space been more immune to the passive wave?
Well, it surprises me because I think people in fixed income feel that active management can add some value. What's amazing is if you look globally, we run a worldwide ETF, DWLD, and an international, DINT, Davis International. And when you look at international indexes, the active managers on average have outperformed in all time periods. It's sort of amazing that people believe that passive investing, because it's done well domestically, it must be true globally. It is not true even for the average manager internationally. So I think that's where you're going to see the biggest mindset adjustment. And I think you've seen some in fixed income where people somehow believe that active management can add value, and yet they don't look at the overwhelming data in global equities where the average manager has outperformed for all periods, and they still somehow think passive is a better strategy.
Do you think that the wave in general to passive has made your job easier to outperform?
Oh, absolutely. Absolutely. You get peculiar inefficiencies. We had a company just a few weeks ago that spun out a division of that company. The spin-out company was removed from every index. The large cap, the mid cap, the small cap, it wasn't put into any index. It fell to something like 4 times earnings. So you get these strange anomalies that I do think happen. So although this is tough for our business in terms of asset gathering, it's wonderful for our investment returns. And we make more money with 10% better performance than 10% more assets under management. So we're fine with this continuing for years to come.